Most people look at life insurance as a passive safety net, a piece of paper tucked in a drawer for a day you hope is far off. But the wealthy treat it very differently. They use it as a highly active, tax-sheltered engine for wealth generation. Take an investor we'll call Lenny. She has already maxed out her RRSP and her TFSA. That means every new dollar she puts into a standard, non-registered investment account gets hit with annual taxes, dragging down her compound growth. This brings us to step 1 of the framework, tax-advantaged accumulation. By depositing her surplus capital into a legally exempt permanent whole life insurance policy, the cash value inside grows completely tax-free under the Canadian Income Tax Act. Over decades, that continuous, sheltered compounding creates a significant pool of capital. When the policy eventually matures, step 2 kicks in. The entire amount pays out to her named beneficiaries as a completely tax-free lump sum. Because the beneficiaries are named directly in the policy, those proceeds bypass her estate entirely. Her capital cleanly dodges Ontario's 1.5% estate administration tax, or probate fees, ensuring every dollar she shielded during her life actually reaches her children. Now let's scale this up. Lenny's business is booming, and she is holding massive retained earnings inside her corporation. If she invests that money passively in a standard corporate account, she faces tax rates exceeding 50% on the growth. Step 3 applies the life insurance shield to her business. Her corporation buys the policy to protect those earnings from annual taxation. But this creates a friction point. When Lenny dies, the corporation receives the tax-free death benefit. But how do her heirs extract that cash from the company without paying heavy dividend taxes? The solution relies on a mechanism called the Capital Dividend Account, or CDA. This is a notional tracking tool created by the Canada Revenue Agency, specifically to allow tax-free money extraction from private corporations. The CRA uses a strict equation to calculate how much you can take out tax-free. It is the total death benefit minus the policy's adjusted cost basis, or ACB. Whatever is left over equals your CDA credit. Look at how this graph works in your favor over time. While the policy's death benefit and cash value steadily grow, its adjusted cost basis actually grinds downwards as you get older, often reaching 0. That shrinking ACB is exactly what maximizes the size of the tax-free CDA credit you can pull out. Let's run the math. If Lenny's corporate policy pays out a $5 million death benefit, and her ACB has ground down to $100,000, what is her tax-free payout? The corporation can distribute $4.9 million completely tax-free to her estate, cleanly unlocking all that trapped corporate wealth. So far, this solves the estate problem, but what if Lenny wants to access that accumulated cash value while she's alive to fund her retirement? She cannot simply pull the cash out of the policy. Direct withdrawals from the cash value are treated by the CRA as taxable income, which would strip away a huge chunk of her capital. Step 4 introduces the workaround, borrowing against the policy's value. Lenny legally assigns her insurance policy to a third-party bank as collateral. In return, the bank gives her a line of credit equal to a large percentage of that cash value. This works because of a basic rule in Canadian tax law. Borrowed money is not taxable income. By using the policy as collateral rather than withdrawing from it, she secures a stream of tax-free cash to live on, while her actual policy value continues compounding uninterrupted. This is known as an insured retirement plan. Upon her death, the tax-free death benefit drops in, first paying off the outstanding bank loan. Whatever is left over routes directly to her heirs. Through leverage, she spent her wealth without technically touching it. We've seen how to use this in retirement. But for business owners focused on aggressive growth today, waiting decades to leverage that capital is too slow. They want to put those dollars to work on day 1. Step 5 is the immediate financing arrangement, or IFA. Instead of waiting, Lenny's corporation deposits a large premium, say $100,000, into the policy, and then immediately turns around and borrows an equivalent amount back from the bank on a collateral line of credit. The corporation then takes that borrowed $100,000 and deploys it right back into the market, purchasing income-producing real estate or expanding core business operations. That exact same dollar is now providing essential insurance protection while simultaneously funding aggressive business growth. Because the borrowed funds are explicitly used to earn business or property income, The Canadian Income Tax Act allows the interest payments on that bank loan to be fully tax-deductible. This 5-step progression takes capital that would otherwise sit stagnant and forces it to perform multiple duties. From sheltering personal wealth to executing a dual-use corporate strategy, this is the exact blueprint the wealthy use to optimize their capital efficiency and legally minimize their lifetime tax exposure. To help you evaluate your own financial architecture, here is a visual summary of the framework. Go ahead and screenshot this cheat sheet and use it to start the conversation with your advisory team.